wants to make money. Everybody has and high interest rates in how they could be rich. And in order for you to do so, you need to have a deepened understanding to Forex and the idea behind Forex. And luckily, I'm here to break it down in a simple and basic term because simplicity is key. So we'll be looking into understanding the basic and common queries in Forex trading. So we're going to go through what is Forex, how Forex works, benefits of Forex trading, common Forex terminology, currency pairs, fundamentals versus technical analysis, risk and risk management, and lastly, we'll look into the popular questions from beginners. What is Forex? Forex is the global markets where currencies are bought and sold or traded. Yes, you're simply buying and selling currencies in the markets. Don't panic. We'll go deeper in the next slide. There's a system and channel as to which trading functions, just as every other economical structure. There's a level of distribution, like wholesalers, retailers, and consumers. The Forex functions in a similar manner. These key participants are banks, financial institutions, known as investors, corporations known as companies, and brokers, and lastly, the individual traders known as the Forex traders. The brokers are people who give the individual traders the opportunity to be a participant in the Forex markets, for example, XNES and Binance, and etc. How does Forex work? This is where it gets interesting. The major strategy to Forex is to buy currency or currencies at a discount and sell at a premium price. How can I sell currency? Now, Forex is the direct opposite of the trade by barter system, where goods and services are traded between two or more parties without the use of money. Now, in Forex, you'll be trading money without goods or services, as the broker will cover that responsibility for you. So to make it as simple as possible, let's say you buy an item that you believe is of great value for $5, and you know there's going to be a high demand for it the following day. So you buy this product at $5 and the product increases to $10 the following day, and you sell it for $10. You just made $5. You simply bought at a discount and sold at a premium. And the brokers are the middlemen to the trader and the interbank Forex markets. That is the role of a broker. Without the broker, Forex traders cannot exist. The Forex market is of huge relevance. It has a huge space as it has 5.3 trillion transacted daily. Yes, 5.3 trillion transacted daily, which provides us the enormous opportunities and benefits. Through the volatility gives us the opportunity to make more profits during the market sessions. Now, the market is open 24 hours a day. Now, you can be profitable in the market from Mondays to Fridays, and the market is closed during the weekends. Another benefit to Forex trading are the ability to leverage. Now, leverage helps you use your capital to the maximum advantage, so you can gain an enormous amount of money. So it's more like borrowing money to make more money, to start up a business to make more money. And the side effect of it is you can also lose an enormous amount of money because you'll be risking more. What are the common temps in the Forex markets? The common temps in the Forex markets are the pips, the spread, the margins, the lot size, and the bulls and bears. The pips are the percentage in points that gives you a good overview of what you would attain if the price moves a certain point. Now, the spread is the difference between the buy and the sell price on the markets. If you go to an exchange, if you have $1, you want to switch it to a euro, you go to an exchange, you can always see there is a buy quota and there's a sell quota, and they're not the same price. So that is the spread. It's the difference between a buy and a sell. Whereas margin is the funds you need in your account to open the transaction. So having $100 is your margin towards the spread you see in an exchange office. While lots in Forex refers to the standard size of a trading contract. There are three different types of lots in the Forex markets. We have the standard lot size, we have the mini lot size, and we have the micro lot size. The most popular of them all, lastly, are the bulls and bears. And in the bulls indicate a buy signal and the bears indicate a sell signal. When you're trading Forex, you'll be trading in currencies, and you need to know that you trade in pairs. It means you have to trade a currency for another currency. So we have 70 currency pairs offered by brokers in the markets. And we have three major pairs, which are the major, minor, and exotic pairs. So the major currencies are Canadian dollars, US dollars, pounds, euros, CHF, known as the Switzerland currency, Australian dollars, Japanese yen, and New Zealand dollars. Now, like I said, the pairs are broken into three. We have the major, the minor, and the exotic pairs. Now, the major pairs are in conjunction with the US dollars. For example, euros to dollars, pounds to dollars, and dollars to Japanese yen are examples of the major pairs or major currency pairs which you can trade with. And the minor pairs are not in conjunction with the US dollars, but they are associated with the major currency pairs. For example, euros to Canadian dollars, pounds to New Zealand dollars, and Australian dollars to Japanese yen. While the exotic pairs, they consist of one major currency, which is the US dollars, and no other major currencies, which are the sub or primary currencies. For example, US dollars to RUB, which is the Russian currency, the US dollars to MXN, which is the Mexican currency, and the US dollars to ZAR, which is the South African currency. So in order for you to be a profitable trader, you need to have a fundamental and technical knowledge, which is called a technical analysis. And for you to achieve that, there are ways and techniques these traders identify the direction of the markets. And fundamental analysis has to do with the overall economical condition of the markets, which you can find through the GDP data of a country, the business sentiment, the trade balance, unemployment data, and inflation and interest rates of a country. While the technical analysis is the graphical analysis using candlesticks, chart patterns, and also using indicators that help determine the trend, strength, and overall direction of the markets in a daily, weekly, monthly, and yearly cycle. Trading blindly can be very detrimental and risky to your capital and mental health as a trader due to its volatility in the market. One of the most important ways to avoid this challenge is to apply proper risk management. How do you apply a proper risk management? By applying a stop loss and also paying attention to your position size and diversification. And a stop loss is a limit as to how much you can lose or let go. For example, let's say you have $50,000 or you have $100,000, and your friend is in need of $4,000, and you would like to help, but you have a feeling that the friend would not pay back, and due to their past characters and due to the characteristics or attributes you have actually obtained from them over the years, and you still want to help. So you offer $500 because you know if you lose $500, it might not hurt you as much, because probably you wanted to use it to buy a Nike shirt or buy a Louis Vuitton slide, or buy something that's of no relevance to you. So if you lose $500, it would mean nothing to you than having to lose $1,000 or $3,000 to your friend. And that is exactly what a stop loss is. So if you have a stop loss, it gives you the ability to trade more in the markets. And it's like having $1,000 to trade in the markets. And if you have a stop loss of $100, you have 10 attempts in the markets. If you have a stop loss of $50, you have 20 attempts in the markets. If you have a stop loss of $25, you have 50 attempts in the markets. So that's how it works. So the popular questions from beginners: how much money do I need to start trading? Now, the real question is, how much can you lose is the question to this particular question. And the answer to this question gives you the right amount you can most likely start with in Forex trading, as it varies towards the capabilities of each individual, as we have poor, middle class, and rich people. Now, what are the best currency pairs for beginners? Major currency pairs are the best, as they are very volatile due to their volatility rate, and it moves constantly. How can I manage my emotions while trading? This is a common difficulty faced by traders, mostly newbies, people who think they can come into the market to make an enormous amount of money and drive Lamborghinis and drive Ferraris. They obviously fall into this category where they get upset because of how much they have fascinated and built a dream towards the Forex markets, and thinking they can control the markets, which you cannot. And in order for you to manage these emotions, you need to be psychologically aware. And how can you be psychologically aware? You must first begin by identifying how you feel, and then identify the trigger. And once you know these two things, you can learn how to control them. It's like having a headache. And if you have a headache and you take Panadol, you actually did not solve the problem. You just suppress the headache, and maybe in a week it will reoccur again. Maybe the headache could be derived from stress, worrying about situations you cannot control, or most probably looking at the screen too much and you have been affected by the blue rays and you have to tone it down. So you need to identify the real problem, the real trigger that causes these emotions. That is the first step. And most traders, most common triggers to the traders in the market are FOMOs, which is a popular word for fear of missing out. You always think you're losing an opportunity, but the market runs 24/7. It means you have an opportunity every second, every minute. Now, overconfidence is another trigger. When you're too pompous, you think you know it all and you think you can do it, and you start predicting the market instead of reacting to the market, it becomes a huge problem. And when you're unaware of yourself, and if you're unaware of yourself, it means you have problem with your analysis. It means you're not too good with your analysis. And if you're unsure of yourself, it means you're not too good with your analysis. It means you don't trust your analysis that much, because if you have trust in your analysis, you would be in between overconfidence and unsure of yourself. You'll be in the middle. And when you are in the middle, when you have emotional stability, you can perform well. And now this triggers to these emotions can actually cause anger, impatience, and greed. And it can cost a lot more into ruining your capitals and ruining your accounts. And they are mostly subjective to our ability as a trader. And trusting your analysis and trading plans and strategies can actually help you overcome these emotions you face in trading. Is Forex trading risky? Yes, Forex trading is risky. I mean, so is every business-related entity in the world. It is less risky when you do know what you're doing, and it's more risky when you don't. Now, what tools and resources should I use for analysis? You would have to know all the basic knowledge of trading analysis first, and then pick the one you align to. It's similar to education. You study all subjects first to a basic level and develop a deeper knowledge on a subject of interest. And if you do not know the basics and study a specific strategy, it becomes very risky. It's like you're driving 250 meters per hour. And the chances of you crashing the car is much more higher than a Formula One driver on the steering wheel. No matter how confident you claim you are, you would eventually crash it faster than the Formula One driver because knowledge and experience beats belief and hope.